Gentlemen and ladies, welcome back to section 3 of chapter 1. This is going to be a very illuminating section because we're going to be talking about some of the basic parts of the accounting world that are important to its functioning. And the first is something called GAAP, G-A-A-P, and IFRS. What are they? Here again, you may want to stop the video and put this question in your notebook because in the next couple slides I'm going to define that. Well, GAAP stands for Generally Accepted Accounting Principles, and IFRS stands for International Financial Reporting Standards. And basically, these are the rules that govern how accounting is done, both in the United States and around the world. The reason this is important is because if you're going to invest in a business in India or a business in China or a business in Italy, your investment decision is going to be based on the financial statements of that particular company. Now, if everybody is following a different set of rules when they reflect the accounting information for that particular business, you're never going to be sure whether you're able to compare apples to apples. So let's say you're making a choice. Do I invest in the business in India? Do I invest in the business in China? You want to make an apples to apples comparison. And that's what the GAAP and IFRS principles and standards allow you to do. The people that actually make these particular rules are called the Financial Accounting Standards Board, and that's the current rulemaking body in the U.S., and the International Accounting Standards Board. And they work together, obviously, so that they have consistency between what the rules are in the U.S. versus what the rules are internationally. Okay, changing gears here. We're going to now answer the question, what makes information useful? Accounting is all about the classification of information. So, as with any resource, it has to meet certain criteria. And the three criteria that need to be met for accounting information is relevance, reliability, and benefits. By relevance, I mean, is the information that you're going to be using to construct your financial statements actually going to be capable of making a difference in a decision? Will it be predictive? Will it provide feedback that will be timely and of value? By reliability, I mean, is the information dependable? Is it accurate? Can it be verified? Does it really represent what happened? Did you actually sell 100 of a given item in a given period? Last but not least is, does the benefits, meaning that the information's value, going to exceed the costs? Because if it doesn't, then it's probably not a good business decision. Okay, so now we're going to move into the 4 basic financial statements in the auditor's report. Now, you're probably going to want to stop the video here again because this is extremely important information. You want to make sure that you get this in your notes. But the first basic financial statement, which you have already been introduced to, is the income statement. And the income statement, as we talked about in the little candy business example that we gave, is basically a representation of revenues less expenses, which equals net income for a period of time. And we didn't really emphasize period of time in our candy example, but it's very important in the accounting world, because if you have a statement of income, everybody wants to know, when did it happen? Was it a year? Was it a month? Was it a week? And what exactly was the date that this information refers to? So in this particular case, as you can see toward the middle of the page, this is a chair business. It's called Chair Depot, and it's an income statement for the year ending December 31st, 20x3. We can put a 1 there and say this is for the year ending December 31st, 2013. So you know what period of time and what particular year this refers to. So in this particular year, this particular business sold about $200,000 worth of chairs. Like any business, right, there were some returns. There might have been some defective product. $10,000 of returns came back. So the net sales was $190,000. 10 minus 200. Okay, so those are net sales. You actually had some costs associated with those particular chairs, right? You had to pay somebody either to make the chairs, or you had to pay your employees to make the chairs and buy materials to make those. And that particular category is called cost of goods sold. You'll see that quite frequently on an income statement, especially in a more complex business. So the cost of goods sold here was $114,000. And that is subtracted from net sales, right? So the gross profit before expenses is $76,000. Now, you had some expenses, or this business had some expenses associated with those particular chairs. They had advertising expense. They had salaries of people working in the store, and they also had rent for the location and building. And so that totals, if you add these three up, that's $20,000. And so, similar to your candy bar example that we went over earlier, you subtract the 20 from the 76, and you end up with a net income of $56,000. Again, very straightforward, but a very important statement in accounting, because, as we talked about before, it basically shows if you're making any money. That's the only reason to be in business. Okay, the second statement, again, you might want to make sure you get this in your notes, is the statement of cash flows. Now, the reason this is so important is that cash flows pretty much determine whether you're going to stay in business or you're going to be calling Peter Francis Tracy. Because cash is like oxygen for a business. If you do not have cash to pay your employees, to pay your vendors, pretty much out of business. So you need cash coming into your business, and you need cash, therefore, to flow out of your business so that you can continue to remain as a business. So that's the second statement. The third statement, and it's going to be the last one that we talk about today, is the statement of owner's equity. So the statement of owner's equity basically reflects what was paid into a business by the owners or investors, or what was paid into the business from the earnings that were generated. So let me give you an example as we go through this particular statement. It says, okay, in terms of paid in capital, capital is another word for cash. There was some stock that was issued that had a par value of $5, and 10,000 shares were actually issued. So if you take 5 times 10,000, that equals $50,000 was basically put into the business. Then you have something called additional paid in capital. So let's say one of the owners wanted to invest additional money. That would be reflected here. And so at the end of March 31st, there was $100,000 of paid in capital. Now, the other source of owner's equity, meaning the amount that has been invested in the business, is actual earnings that were generated by the business. And so at the end of the year, you can take the income and you can either distribute it to shareholders or yourself, or you can keep it in the business. And this is where retained earnings come into play. So in this particular business, they had net income for the year of $30,000. And they essentially decided to keep most of that in the business. They were only going to distribute in dividends approximately $1,000 of that. And so they deducted that $1,000, and that represents retained earnings balance of $29,000. So if you look at the total amount of money that has been invested in this particular business, XYT Computer, there's $100,000 in paid in capital, and there is $29,000 of retained earnings. So the total earnings, owner's equity, is $129,000. Okay, guys, so we have completed this particular section. Please review your notes. There will be a quiz when you come to class.